The world's greatest investors. Great money managers are like the rock stars of the financial world. The greatest investors have all made a fortune off of their success, and in many cases, they've helped millions of others achieve similar returns. These investors differ widely in the strategies and philosophies they applied to their trading. Some came up with new and innovative ways to analyze their investments, while others picked securities almost entirely by instinct. Where these investors don't differ is in their ability to consistently beat the market. Benjamin Graham. Ben Graham excelled as an investment manager and financial educator. He authored, among other works, 2 investment classics of unparalleled importance. He is also universally recognized as the father of 2 fundamental investment disciplines: security analysis and value investing. The essence of Graham's value investing is that any investment should be worth substantially more than an investor has to pay for it. John Templeton. John Templeton was one of the past century's top contrarians. He bought low during the Depression and sold high during the internet boom, and made more than a few good calls in between. Templeton created some of the world's largest and most successful international investment funds. In 1999, Money magazine called him arguably the greatest global stock picker of the century.
Second year at Yale, my father told me that he couldn't give me even $1 to go back to college. I thought that was a tragedy, but it turned out to be one of the greatest blessings anybody ever gave me, because it made me an adult. It made me stand on my own 2 feet. It meant I learned to work hard, because working hard was the way to produce a better result.
Thomas Rowe Price Jr. He is considered to be the father of growth investing. He spent his formative years struggling with the Depression. And the lesson he learned was not to stay out of stocks, but to embrace them. Price viewed financial markets as cyclical. As a crowd opposer, he took to investing in good companies for the long term, which was virtually unheard of at this time. His investment philosophy was that investors had to put more focus on individual stock picking for the long term. John Neff. Neff joined Wellington Management Company in 1964, and stayed with the company for more than 30 years, managing 3 of its funds. His preferred investment tactic involved investing in popular industries through indirect paths. And he was considered a value investor as he focused on companies with low P/E ratios and strong dividend yields. He ran the Windsor Fund for 31 years, ending in 1995, and earned a return of 13.7%, versus 10.6% for the S&P 500 over the same time span. This amounts to a gain of more than 53 times an initial investment made in 1964. Jesse Livermore. Jesse Livermore had no formal education or stock trading experience. He was a self-made man who learned from his winners as well as his losers. Livermore began trading for himself in his early teens, and by the age of 16, he had reportedly produced gains of over $1,000, which was big money in those days. Over the next several years, he made money betting against the so-called bucket shops, which didn't handle legitimate trades. Customers bet against the house on stock price movements. Peter Lynch. Peter Lynch managed the Fidelity Magellan Fund from 1977 to 1990, during which the fund's assets grew from $18 million to $14 billion. More importantly, Lynch reportedly beat the S&P 500 index benchmark in 11 of those 13 years, achieving an annual average return of 29%. Often described as a chameleon, Peter Lynch adapted to whatever investment style worked at the time. But when it came to picking specific stocks, Peter Lynch stuck to what he knew and or could easily understand.
I'm going to try and say some words on the things I've used over the years when I was an amateur, when I ran Magellan. I still use today. I think they make sense. I think they make a lot of sense for investors, and I frankly think it's a tragedy in America that the small investor has been convinced by the media, the print media, the radio, the television media, that they don't have a chance. The big institutions with all their computers and all their degrees and all their money have all the edges, and it just isn't true at all. And when they're convinced, when this happens, when this occurs, people act accordingly. When they believe it, they buy stocks for a week, and they buy options, and they buy the Chile fund this week, and next week it's the Argentina fund, and they get results proportionate to that kind of investing. And that's very bothersome. I think the public can do extremely well in the stock market on their own. I think the fact that institutions dominate the market today is a positive.
George Soros. George Soros was a master at translating broad brush economic trends into highly leveraged, killer plays in bonds and currencies. As an investor, Soros was a short-term speculator, making huge bets on the directions of financial markets. In 1973, George Soros founded the hedge fund company of Soros Fund Management, which eventually evolved into the well-known and respected Quantum Fund. For almost 2 decades, he ran this aggressive and successful hedge fund, reportedly racking up returns in excess of 30% per year and, on 2 occasions, posting annual returns of more than 100%. Warren Buffett. Referred to as the Oracle of Omaha, Warren Buffett is viewed as one of the most successful investors in history. Following the principles set out by Benjamin Graham, he has amassed a multi-billion-dollar fortune mainly through buying stocks and companies through Berkshire Hathaway. Those who invested $10,000 in Berkshire Hathaway in 1965 are above the $165 million mark today. John Bogle. Bogle founded the Vanguard Group Mutual Fund Company in 1975 and made it into one of the world's largest and most respected fund sponsors. He created and introduced the first index fund, Vanguard 500, in 1976. Jack Bogle's investing philosophy advocates capturing market returns by investing in broad-based index mutual funds that are characterized as no-load, low-cost, low-turnover, and passively managed. Carl Icahn. Carl Icahn is an activist and pugnacious investor that uses ownership positions in publicly held companies to force changes to increase the value of his shares. Icahn started his corporate rating activities in earnest in the late 1970s and hit the big leagues with his hostile takeover of TWA in 1985. Icahn is most famous for the Icahn lift. This is the Wall Street catchphrase that describes the upward bounce in a company's stock price that typically happens when Carl Icahn starts buying the stock of a company he believes is poorly managed. William H. Gross. Considered the king of bonds, Bill Gross is the world's leading bond fund manager. As the founder and managing director of the PIMCO family of bond funds, he and his team have more than $1.92 trillion in fixed income assets under management. In 1996, Gross was the first portfolio manager inducted into the Fixed Income Analyst Society Inc. Hall of Fame for his contributions to the advancement of bond and portfolio analysis. Thanks for watching the video. If you like it, then hit the like button and subscribe to our channel to watch out more informative videos.